I'm sure you've heard permanent insurance is so expensive. Well, by the end of this video, we're going to give you all the facts so that you know exactly what they're talking about so that you can make the best decision.
Welcome back to Navigate Your Wealth. I'm Samantha Irish.
And I'm Karen Stawicki.
For the best advice on how to use both life insurance and annuities to create a successful retirement, subscribe to our channel. And don't forget to hit the notifications bell so that you get notified every time we post a new video. So, what's the difference between term and permanent insurance? Most of the time, life insurance is explained like this. Term is cheap and permanent is expensive. But is that actually true? If you have nothing left at the end of all of your payments, is that actually expensive?
You know, Susie Orman says if you got to have insurance, you might as well buy the cheapest kind that you can possibly get. And Susie Orman is right about a number of things, but her choice of insurance is dead wrong.
Yeah.
And here's why. Susie will tell you that when you retire, you're going to have a pension, the kids are going to be gone, the house is going to be paid up. So what do you need insurance for? Because in many cases, you buy insurance to cover the kids getting through school, in case you lose your job so you can pay off your mortgage. But here's something I want you to consider. You bought term insurance, now you're retired, you didn't get a pension, the kids used to be gone, but some of them moved back home, and now you had to refinance the house to make ends meet, and guess what? Your term insurance is about to expire. How good is that advice working out for you right now? Wouldn't it have been better to have a policy that's still in place and not one that you now have to decide whether you have to pay higher premiums to keep?
Absolutely. You know, when we talk about expense, I want to change your thinking of it because you're thinking about your out of pocket. You're thinking about the dollar that you have to pay today. But if let's take an adventure together. Join me. We're driving downtown and there's a parking garage. On your right, the parking garage is $1. Seems like a not expensive parking garage. Of course, I'm going to park there. But you notice on the left, the parking garage is $5. And you think, why in the world would I park at the parking garage for $5 if I could park at the parking garage for $1? You pull into the parking garage for $1, you drop your car off. You go downtown, you have the best day, and on your way back, you pass the parking garage that was $5. That $5 parking garage says, park here, $5. In small print, it says, when you leave, we'll give you $8 back.
Which one was more expensive now?
I mean, sometimes we're so focused on the out of pocket that we don't read the fine print.
Okay, so that's how it works with the parking garage. Let's help you understand how it works with insurance. Term insurance and permanent insurance. And of course, with permanent insurance, just to be clear, we're talking about whole life, index universal life, variable life, or universal life. Those are 4 varieties of permanent insurance. And again, from previous videos that we've done, permanent insurance has cash value. All right. So now you decide that you want the term policy. You're 30 years old and you only need it until you're 60. So you buy a 30-year level term policy. For $1 million of coverage, you're probably going to pay over that 30-year period of time about $20,000. So $20,000 at 60 years old is gone, and so is the insurance. Now, with permanent insurance, your premium is going to be higher. Remember, that's the negative, right? So you're now going to pay from 30 till 60 about $200,000, 10 times more than the $20,000.
Right.
So that's the reason people say it's too expensive. But stay with me. Now at 60, your premiums are done. We chose a policy that allowed you to stop funding it at 60 years old. Your insurance is not only not gone, there's $400,000 of cash value in that policy, and you still have $1 million death benefit that you can now enjoy. Here's something else. From 30 until 60, you could have been using that cash value. You could have been accessing some of the living benefits of that policy. So now I want to ask the question, was it more expensive to have term insurance or permanent insurance?
Yeah.
$20,000 out of pocket and gone, and the death benefit gone as well. Or $200,000 invested with $400,000 of cash value and the $1 million death benefit still in place.
Leave a comment in the section below and let us know if you have term insurance or permanent, and after our expense conversation, what questions you may have. Also, don't forget to check out the video titled How to Get Tax-Free Income Out of My Permanent Life Insurance. This is where we basically explain all of the ways that you can benefit from life insurance during your life.
So we're talking about 20,000 versus 200,000. And I know some of you out there are thinking, why don't we just buy term and invest the difference? Why would I do that crazy $200,000 in insurance premiums? And here's what we're going to do. Hopefully we're going to put this idea, this concept of buy term, invest the difference to bed, to rest forever. It doesn't generally work. And here's why it doesn't generally work. You take the same amount of money that you were going to put in the permanent and you divide it up. You say, okay, I'm going to buy the cheap term insurance and I'm going to invest the difference. And while the market is going up, you are dutifully investing, because that's what we do. We buy when everybody else is buying. The problem is when the market retreats, so do you. So you stop investing at best, and worse, you pillage the investments that you already have because things are going awry, right? So now you don't have the investment. The term insurance eventually runs out. You don't have either. So it just generally does not work.
Absolutely. Well, and one more thing, the buy term, invest the difference person, assuming that they do stick with it. You've got, a rock solid stomach and you're sticking with it no matter what. Eventually, you're still going to surrender your term policy. You're going to lose the death benefit. Now, Susie Orman says that you just won't need it, so it's fine. But the truth of the matter is, you won't be able to afford it because the cost of the term insurance, while it feels like pennies up front, is too expensive in the end for you to be able to keep it. So the person with the permanent insurance has the cash value and the death benefit. Now all of the premiums are paid and there's no more premiums that are due. That entire benefit is 100% tax-free to them during their life and to their beneficiaries upon their death.
Let's talk about the death benefit for a second.
Okay.
Because I think we talk about the premium and we're talking about the cash value and we're talking about the tax-free, but I want to take just a minute and help all of you to understand really the value of the death benefit. And to do that, I'm going to tell a story.
Okay.
All right? So it's going to be spring, and I'm going to hand you a check for $500,000, payable in 8 months on December 31st, $500,000, tax-free.
Okay.
Will the presence of that check change your behavior over the next 8 months in any way?
Probably not. I mean, I can't cash it till January.
Okay, let me help you dream for a second.
Okay.
You know $500,000 is coming on December 31st, and it's tax-free.
Okay.
So let me help you a little bit. How about if you go down to HR this afternoon and tell them that you want to change your tax withholding so that every 2 weeks your check is bigger?
Okay.
Sounds fun, right?
Yeah.
Because you know that come April when taxes are due, you're not going to jail.
Right.
Because on December 31st, you got a check that's going to more than cover the taxes.
Right.
All right, let's dream some more.
Okay.
That car you were going to get next year when you got your bonus.
Okay.
We're going shopping this weekend. What color do you like?
Red.
Right? Because now we know that on December 31st, you can pay that car off.
Okay.
That trip that you were going to take with your family.
We're
You're
taking
booking
it.
All right. Now, if I take that check away from you, can you still do those things?
With a little debt, but yeah.
Yeah. Chances are, when I ask that question, most people say, no, I can't do that. And that's right. That's a good answer, actually. It's a better answer than yours. Because you don't want debt, and you don't want to incur the risk of going to jail when you can't pay your taxes in April. So interestingly enough, the presence of that check gave Samantha the permission to take the trip, to buy the car, to raise her withholding so that she got a bigger check every 2 weeks. And yet when I took that check away, she knew best not to do those things. That death benefit is that $500,000 check for each of you. Understand that when you own permanent insurance, which is why you don't want to have term insurance for this particular case, when you have permanent insurance in place and there's a 1 in 1 chance that you're going to die, we all are, we just don't know when December 31st is coming for each of us.
Right.
But December 31st is coming. If I know that I have permanent insurance in place, I now have the permission to consume my wealth with my family, to enjoy all of those memories, make those memories, instead of being paralyzed by fear of running out of money and not doing the things that I want to do with my family.
Yeah.
That, folks, is the value of permanent insurance and the death benefit that will be there the day you die.
If you want to understand how you can spend your death benefit during your life, click on the link below and apply to become our client. As always, if you liked this video, please give it a thumbs up, subscribe to our channel, and share it with a friend. Thank you so much for watching, and if what you thought to be true turned out not to be, when would you want to know it?
When would you want to know it?